look at what drives institutional interest demand in gold. It's market uncertainty, it's interest rates. Linked to that is obviously inflation. In periods of low inflation, the nominal return for gold, I mean, our research shows is around about 6%. In periods of high inflation, it can be up to 15%. So the data shows that historically, when inflation picks up, interest in gold picks up, but that takes time. And if you look at comments throughout this year, policymaker comments, there's a big debate as to whether the inflation scenario is going to be transitory or sustained. And I think given the comments that we saw from the Fed yesterday, it's increasingly looking like it's not transitory, it's sustained. I would expect institutional interest in gold in particular to start picking up.
And what will drive demand? Do you think interest would continue to come from markets like India and China?
Absolutely. I mean, the major consuming markets, but also we're seeing a digital revolution taking place in both of those markets, which is increasing access to gold for consumers. We're also seeing increased interest in gold, physically backed gold ETFs in those markets as well. If you look at what's happened this year, there's been a slight outflow from gold ETFs year to date. That's driven by the ETFs in the North American markets and in Europe. If you look at in Asia, actually, we've seen almost 22% inflows into gold-backed ETFs this year. So there's certainly an uptick in interest, particularly consumer interest in those markets, but new products driven by the technology revolution, digitization, that is also increasing access to gold in these markets. And we'd expect that to continue next year because consumer demand for gold is driven by economic expansion, whereas institutional interest in gold is often driven by market uncertainty. And that's what makes gold unique. It's both pro and counter-cyclical, unlike most other assets.